All right, let's dive in. Today we're tackling The Simple Path to Wealth by J.L. Collins.
Sounds good.
Our listeners sent in some excerpts, right?
Yeah, looks like they want to get the gist without reading the whole thing.
Makes sense. So, like, we're their financial freedom shortcut.
Exactly. And J.L. Collins, he really breaks things down, makes it easy to understand.
Totally. And he starts with this idea of, get this, FU money.
Catchy, isn't it?
Yeah, but it's more than just a funny name.
Right. It really captures what financial independence is all about, like having enough to make your own choices, not being held back by money.
So it's not about, like, yachts and mansions.
Not necessarily. It's about freedom. Freedom to say no to things you don't want.
Like a job you hate.
Exactly. Or a bad relationship. Anything that's holding you back, really.
I like that. So there's this story, right, about J.L. Collins quitting his job at 25 to travel Europe.
Oh, yeah, with just $5,000.
Wait, 5,000 for all of Europe?
And here's the thing. Because he had that FU money, he was prepared to walk away.
Interesting.
And that gave him leverage. He ended up negotiating a 6-week leave of absence instead of just getting a flat-out no.
So even a little savings can make a difference.
Absolutely. It gives you options, the power to negotiate, take risks.
That's pretty cool. I mean, most of us, we're kind of stuck, right?
Yeah.
Student loans, mortgages, the whole deal.
Yeah, and we're told some debt is good debt.
Right. Like mortgages and student loans.
But J.L. Collins, he challenges that. He says all debt, even the so-called good kind, can slow you down.
Interesting.
Think about it. He paid for college working summer jobs. Not sure how many people could pull that off today.
Yeah, with college costs these days. Yikes.
It makes you think, right?
Yeah.
About the long-term cost of debt, even if it seems good at the time.
Totally. So what's the secret sauce? J.L. Collins' magic formula for building wealth.
Lay it on me.
Okay, are you ready? Spend less than you earn.
Makes sense.
Invest the surplus. And avoid debt.
Simple but powerful, right?
It really is. It's like the foundation.
Exactly. You can't build a house without a solid foundation.
And he makes this point about spending levels, right? Like where you spend your money determines your financial outcome.
Whether you're poor, middle class, or rich, it all comes down to your spending habits.
Makes total sense.
But saving's not enough. You got to invest that money to make it grow.
Right. And this is where things get interesting. Compounding and opportunity cost.
Two powerful concepts.
Okay, compounding, I kind of get it. It's like your money earns money, which earns more money, like a snowball effect.
Exactly. It's the magic of letting your money work for you.
But opportunity cost, that one's a bit trickier.
It's about recognizing that every spending decision comes with a trade-off. Like, what could you have done with that money instead?
Okay, so like that daily latte, it's not just $5.
It's also a missed investment opportunity.
Wow. I never thought of it that way.
Think of it like this. Imagine you buy a car for, say, $20,000.
Okay, yeah.
What if you invested that money instead? Over 10 years, with compounding, it could grow significantly.
That's a big difference. But the stock market, it can be scary, all those crashes and ups and downs.
It's natural to feel that way. But J.L. Collins argues that market crashes are actually inevitable, part of the game.
Really?
Think about it. When prices drop, you can buy more for your money.
Like a sale on stocks.
Exactly. And historically, the market always bounces back, reaches new highs eventually.
I guess that makes sense.
He talks about the 1987 crash. He almost panicked and sold everything.
Whoa.
But he held on, learned a valuable lesson about resilience.
And he mentions Warren Buffett, right? Famous for staying calm during those dips.
It's about focusing on the long game, not getting spooked by short-term fluctuations.
Makes sense. But so many people lose money in the market. Why is that?
J.L. Collins points to some common traps, like trying to time the market, picking individual stocks, chasing hot mutual funds.
So trying to be a stock-picking guru is a bad idea.
He compares the stock market to a beer with foam.
Beer. Okay, I'm listening.
The underlying businesses are the beer, the solid foundation.
And the foam.
That's the short-term hype. Fleeting and meaningless.
So focus on the beer, not the foam.
Exactly. The solid businesses driving long-term value.
I like that analogy. So if picking stocks is out, what does he recommend?
Index funds, specifically Vanguard's Total Stock Market Index Fund, VTSAX.
Index funds, VTSAX. Break that down for me.
A total stock market index fund like VTSAX basically buys a tiny piece of every company in the stock market.
You're instantly diversified
Exactly. Spread the risk across thousands of companies.
instead of putting all your eggs in one basket.
And J.L. Collins says this approach beats actively managed funds, where fund managers try to pick winners.
So I don't need to be a Wall Street whiz.
Nope. Index funds are simple, effective, and low cost. And speaking of cost, those fees can really eat into your returns over time.
So finding low-cost investments is key.
Absolutely. That's another reason he likes Vanguard. Super low fees.
Okay, starting to see the appeal now. But we've been talking stocks. What about bonds?
Good question. Bonds are essentially loans you make to governments or corporations, generally less risky than stocks. Can add some stability to your portfolio.
So it's about balancing risk and reward, right?
Yes.
Stocks for growth, bonds for stability.
Exactly. And this is where asset allocation comes in. Deciding how much to put in stocks versus bonds.
Is there a magic formula for that?
Not really. It depends on your risk tolerance, your time horizon, your goals. J.L. Collins does offer some portfolio examples in his book to get you thinking.
Okay, we'll have to dig into those. But first, what's with his view on international funds? Seems pretty specific.
Yeah, he's got some interesting thoughts there. Argues that U.S. companies are already so global.
So investing in the U.S. market already gives you international exposure.
That's his thinking. But he does offer alternatives for those who still want dedicated international holdings. We can explore those later, too.
Sounds good. This is getting really interesting, so don't go anywhere. We'll be back in a flash to dive into those portfolio examples and more. Stay tuned.
Welcome back. Ready to jump back into J.L. Collins' world?
Totally. We left off talking about asset allocation. That's stocks versus bonds thing. And he has these two portfolio examples, right, to illustrate the idea.
The wealth accumulation and the wealth preservation portfolios, yep.
Names are pretty straightforward. Let's break them down anyway. So wealth accumulation, that's for people still building their wealth, right?
Exactly. Younger folks, typically. Further away from retirement.
So like if I'm in my 20s or 30s hustling to save, this one's for me.
You got it. And it's simple. 100% stocks.
Whoa, all in on stocks. Sounds kind of risky.
It is more aggressive, sure. But younger investors, they've got time on their side, can handle those market ups and downs.
Because they have longer to recover if things go bad.
Exactly. And over the long haul, stocks tend to have higher growth potential than bonds.
So it's a calculated risk.
Exactly. Now, the wealth preservation portfolio, that's for folks nearing retirement or already there.
Okay, so if I'm thinking about those margaritas on the beach.
That's the one. This one's more about protecting what you've earned, generating income. So it's a mix of stocks and bonds.
Makes sense. Don't want to be too risky when you're relying on that money.
Exactly. The exact mix depends on your risk tolerance, how much income you need, all that. J.L. Collins gives some general guidelines, but a financial advisor can help you fine-tune it.
Good point. Always good to get personalized advice. Now, about those international funds, J.L. Collins has a pretty unique take on those, right?
Yeah, he thinks a lot of U.S. investors can skip them entirely.
Seriously, why is that?
His argument is that U.S. companies, many of them are global already, operations all over the world.
So like investing in Apple or Microsoft is kind of already a global play.
You got it. But he does suggest a global index fund for folks who want that dedicated international exposure.
So there are options. It's all about what aligns with your investment philosophy. Speaking of options, let's talk tax-advantaged accounts. Those can really boost your returns, right?
Big time. J.L. Collins breaks down the various types like 401k, IRAs, Roth IRAs, even HSAs.
Whoa, acronym overload. What are the main differences?
The key is when you get the tax break. Traditional 401ks and IRAs, you contribute pre-tax money, lowers your taxable income now, but you pay taxes when you withdraw in retirement.
So you're delaying the tax bill.
Exactly.
Wow.
With the Roth IRAs, it's the opposite. You contribute after-tax dollars, no immediate tax break. But the withdrawals in retirement, those are tax-free.
Tax-free retirement withdrawals. Sounds pretty sweet.
It can be a huge benefit.
Yep.
Especially if you'll be in a higher tax bracket later on.
So how do you decide which one's best?
J.L. Collins lays out some guidelines. Young, lower tax bracket now, Roth might be better. Higher tax bracket, want to reduce your taxes now, traditional could be a good fit. But every situation's different. So, again, financial advisor can help you tailor it.
Always good to have a pro in your corner. All right, we've talked a lot about building wealth, but what about spending it in retirement? The 4% rule, that's a big part of J.L. Collins' philosophy, right?
It is. It's a guideline for how much you can safely withdraw each year without running out of money.
How does it work again?
Based on historical data, withdrawing 4% of your initial portfolio balance, adjusted for inflation, should let your money last at least 30 years.
So $1 million saved, I could take out 40,000 the first year, then adjust for inflation.
That's the general idea, but it's just a guideline, not a guarantee. He stresses that.
What else should people keep in mind with the 4% rule?
Market returns are never certain. Bad returns early on, you might need to adjust. And your individual situation matters: health, life expectancy, lifestyle.
So it's not just set it and forget it.
Right. Be flexible, adjust as needed. Now, about Social Security, that's a big piece of the puzzle for many.
Yeah, what does J.L. Collins say about that?
He's pretty straight up, acknowledges the challenges the program faces, says, plan as if it won't be there.
Whoa, really? No Social Security at all?
He doesn't say completely ignore it. Explains how it works, different claiming strategies, but his point is aim to be financially independent so you don't have to rely on it.
So more of a bonus than a lifeline.
Exactly.
Yeah.
If it's there, great. But don't build your whole plan around it.
Makes sense. Ties back to that FU money idea.
Yeah.
The more secure you are, the more choices you have, even in retirement.
Absolutely. And that leads to something J.L. Collins emphasizes throughout the book. Financial freedom isn't just about the numbers, it's about the life you want to live.
Yeah, using money as a tool to achieve your goals, right? Live a life with meaning.
Exactly. We can get so caught up in accumulating wealth, we forget to ask, what are we working towards?
What are we working towards? That's a great question to ponder as we head into part 3. We'll explore the true meaning of financial freedom and what it can unlock in your life. Don't miss it. We're back, ready to wrap up our deep dive into the simple path to wealth.
Let's do it.
Before the break, we were talking about how financial freedom, it's not just about the money itself, right? It's about what that money lets you do.
Exactly. J.L. Collins, he really gets that. He shares stories about retiring early, traveling, following his passions. It's about creating a life that fits you, your values.
Yeah, he talks about having the time to care for his aging mother, spending time with his daughter, things you can't put a price tag on.
And he stresses it's not just for the super rich, this financial freedom. Anyone can get there with the right approach.
He's so optimistic, it's contagious. But let's face it, money can be stressful, right? Markets going up and down, it's a roller coaster. How do you handle that emotional side of things?
J.L. Collins addresses that head on. Talks about fear and greed driving bad decisions. He's all about the long-term mindset, not getting caught up in the day-to-day noise.
He even tells a story about almost selling all his investments during a crash.
Oh, yeah, I remember that one. He almost panicked.
God, he didn't, thankfully. Learned a valuable lesson about staying the course.
So important. It's easy to get spooked when everyone else is selling.
Right. But J.L. Collins reminds us, downturns are normal, part of the cycle.
And often they're the best time to buy. Like Warren Buffett, he made a killing during those times.
That's reassuring. So how do you build that mental toughness? Any tips?
J.L. Collins, he's big on education. The more you understand, the less you panic.
Makes sense.
Yeah.
And having a plan, right. Sticking to it no matter what.
Absolutely. That's your anchor when things get stormy. Keeps you from making rash decisions.
Okay, so let's say we built our nest egg, weathered the storms, and we're ready to retire. How do we make that money last?
Well, that's where the 4% rule comes back in. We touched on it before.
Right, remind me how it works again.
So you withdraw 4% of your portfolio each year, adjust for inflation. Historically, that should let your money last at least 30 years.
$1 million save, 40 grand a year, adjust for inflation. Got it. But it's just a guideline, right? Not a guarantee.
Exactly. J.L. Collins really stresses that. Your own situation matters too. Health, how long you think you'll live, your lifestyle.
All right, if you're going to travel the world, might need to adjust things.
It's about finding that balance, enjoying retirement, but not running out of money.
Makes sense. What about factoring in Social Security?
J.L. Collins, he's a bit cautious on that front, says, plan as if it won't be there.
Really? So no relying on Social Security at all?
He doesn't say to ignore it completely. He explains how it all works. But his point is, be financially independent enough that you don't need it.
So it's a bonus, not the foundation of your plan.
Exactly. If it's there, great. But don't bet everything on it.
Okay, that makes sense. And it ties back to that FU money. The more you have, the more choices you have, even in retirement.
Absolutely. And ultimately, it's about more than just the money. J.L. Collins emphasizes that throughout the book. It's about the life you want to create.
Yeah, using money as a tool to achieve your goals, to live a life with purpose.
He really inspires you to think beyond just accumulating wealth.
So as we wrap up our deep dive into the simple path to wealth, I have a question for our listeners. What would financial freedom mean for you? What dreams would you chase? What adventures would you have?
J.L. Collins gave us the map. Now it's up to each of us to explore.
Remember, it's a marathon, not a sprint. Be patient, learn, and keep growing. There's a ton of info out there to help you on your journey. And hey, maybe one day you'll be sharing your story of financial freedom, inspiring others.
That's a great goal.
Thanks for joining us on this deep dive. Keep learning, keep growing, and keep seeking that knowledge that empowers you to live your best life.